Cashflow Chronicles. So today, Chris and I quickly chatted just through DMs and stuff on Twitter or X, as people call it these days. And I was like, what do we get to talk about today? Obviously, we weren't going to talk about the rug pull that is the New York Stock Exchange or Nvidia, but I thought it prudent for us to kind of take a look. And this isn't something that is a one and done, right? This is probably something that we're going to talk about. If this continues to go on as a show, maybe once a month or maybe even once a quarter or something like that, because this is something that is so important that if audience is coming in and out, it's something that is kind of an evergreen topic that it's one of those things where, and Chris, I'm sure you fell into a lot of these traps. I know I fell into a lot of these traps. It's like one of those things where you start to know a little bit and you feel like you kind of know what you're doing, kind of like as a teenager. And next thing you get your feet in some cement and you're like, ah, shit. Right. And so these are just eventual mistakes that you kind of learn. And we're hoping that knowing some of these things can shave 6 months or even a year off of your learning curve. And, once another thing to kind of take away from this is you're never done learning. Just because I've been doing this for 10 years in the investing community, you still learn about the things that you think that you really don't know. And at the end of the day, what you can do is just have a pile of experiences and hopefully just continue to build a repertoire. But I want to kick off with, and then I'll hand it over to Chris to see if he has any thoughts about the topic as well. The 5 things that I always like to talk about when somebody's just getting started in investing. And it seems childish, right? And it seems like you're like, oh, okay, sure, whatever, funny man. Like, just tell me the ticker symbols. But in reality, in 5-10 years or time, you'll actually sit there and be like, that makes a lot more sense now that I think about it. And every time you enter like a BlackRock or like a Fidelity or a Schwab, they ask very similar questions. So you probably gloss over it, don't give it a second look. But I'm here telling you these 5 things are very important. And this is the way I phrase it. Other people might phrase it differently. First and foremost, what are you investing for? What's your objective? Are you doing it to save up for a house? Are you doing it for early retirement, to get rich, to do whatever? What are you doing it for? Because if you don't have a clear idea, you're going to be kind of wandering around aimlessly without any sort of direction, right? Second, what's your time horizon, right? And your objective can play into that very clearly. If you're looking to buy a house in the next 2 years, or you're looking to invest in and get yourself to the 8-figure mark, or hell, even just the 7-figure mark, having that sort of idea as to when you want to get there is going to change drastically how you invest. Thirdly, what's your risk tolerance? If you can't see red on the screen, you're going to invest way differently than if you could tolerate a 10, 20% volatility piece in the market. You can handle a 2022 and recognize, let me just keep adding. Let me keep DCAing it. And, there are some people that I saw that need to relook at that risk tolerance. They said, oh, yeah, I can handle Google. I can handle Palantir. And 2022 came to it and they sold at the bottom, right? I know people that did that. And so just be honest with yourself, because if you're not, you'll end up in a very quick scenario of being down 40, 50% on Google and selling it. And next thing you know, we're back up to where we were, if not slightly better, prior to 2022. So that's the third thing. The fourth thing, how actively are you going to be looking at these investments? Is it something that you're going to look at once a quarter? Is this hour, the only hour that you're putting in once a week? Say you come in to check in on Finance Junkies on Sundays and that's the only thing that you do. You're going to invest completely differently than if you look at your portfolio every single day, or hell, even look at it once a quarter, right? And you have to recognize what type of investments and what your strategy will be in that particular scenario. You can't day trade if you look at it once a quarter, right? I mean, that's just an obvious sort of thing. You laugh, but at the same time, it's true. I know people that have 9-to-5s and they're like, ooh, I'm day trading. It's just like, you have to go to that 9 a.m. meeting. The market's not going to stop, right? So you have to recognize, like, if you're a day trader, you got to be putting in 3, sometimes more hours, looking before the market opens, after the market opens, during market hours. It's a lot. And if you don't have that true dedication or the time to do it, you're going to get yourself in a lot of trouble. And then the last piece, which I also think plays very heavily with everything that we talked about, the other 4 items, is it something where you want to be very active or passive in? And I say this because if you don't have time on the weekends to put in the elbow grease or anything like that, you probably don't want to own any real estate, right? Like, if you don't want to be plunging toilets, don't buy a house to rent out on Airbnb or something of the like. And the same thing with investing in individual stocks. If you don't want to put in the time to listen to conference calls, you don't want to put in the time to kind of like oh, actually, I already kind of said this piece. The fifth actual thing is, how often are you contributing? Right? Are you contributing once a month? Are you contributing multiple times a month? How much are you contributing? You're going to invest completely differently if you have $1,000 and that's the only $1,000 you'll ever have. You live on, say, some sort of handicap, you're disabled, and this is the only $1,000 you're ever going to have, and you want to get to 1 million, and this is the only $1,000 you're ever going to be able to invest. You're going to invest it way differently than if you have a low risk tolerance and you're investing, half of a paycheck every 6 months, or every half month or something like that. Right? If you're saving 10 to 15% of your income, you can afford to take on less risk and get to that $1 million mark over time through incremental investing. And the way I like to explain this one is the easiest. Say you have $1,000, you want to get to $1 million. What's the easiest way for you to double your money? Is to add another $1,000 to the account. Meanwhile, everyone's sitting over here saying, well, I need a 1,000x my money so I can go from 1,000 to $1 million. It's like, what's a lot easier to do? It's literally half as difficult of doing that, adding another $1,000, because now you only have the 500 extra money instead of 1,000 extra money. And let's talk about it again. Add another 1,000 the next month. Now you only have to 330 extra money instead of 1,000 extra money, right? So it's that law of just good decisions, compounding good decisions on top of each other. Now, Chris did a 5-minute soliloquy there, monologue there, but curious what your thoughts are.
No, I agree with everything you're saying. I think one of the tragedies of investing is, in the quest to look for the 5x and the 10x, we pass up the 1x and the 2x return. And what's funny is people end up getting burned by the 5xers way more, right? So a lot of people's portfolios have what I like to call a lot of landmines in them. So could the opportunity be there for for making a ton of money on one stock? Yeah. If you pick a really highly speculative name that just has a really great run up, you could really do well. But there's also some consequences to that, in that you won't be able to nail that many, like, unless you really know what you're doing, you're not going to be able to nail 5 of those companies, so you have to just take into perspective that, like, you want to try to minimize the amount of landmines that you run into. So you do that traditionally by having a portfolio that's diverse, right? So you're not like sitting on 4 stocks or 5 stocks that are basically like your only thing. And if one of them goes down by, like, let's say 20-30%, there goes the return for the entire year, if not the next 5 years, right? So that's one of the things about investing that I hope people take into consideration. And also, just like you said, the market is ever changing. So people often sometimes stay away from thinking about the macro, thinking about all the things that could impact the company and the business, because it just feels like you don't want to be in a position where you're really thinking about those things. And it's hard. It's really hard to be critical of your own investments. And, I know that at times people are just like, well, if I just buy and hold forever, it'll be okay. And I can tell you right now, I've been in the camp of buy and hold forever. Sometimes it works out and sometimes it doesn't. I can tell you when it does work out. Usually, if you buy like an index fund, you can buy those and hold those forever and you'll eventually make good money. Like, I can't even deny that. That's Buffett says it, I'll say it, and it's really hard to beat the index. Now, for someone that's not willing to do a lot of work, they just want to have like a good return coming in about 7, 8, maybe 10% per year. S&P 500 is the way to go for you. Don't even stop watching Cashflow Chronicles, Finance Junkies, all that shit. Just shut that shit off. Just buy an index fund and invest over time, where every month you're taking a little bit of money, putting it in there, and it just keeps going and going and going. And I guarantee you're going to have great returns. Now, if you are interested, you want to actually put in a little bit of work, you kind of want to follow some people, you want to take hold of your own investing journey a little bit, you know, then yeah, you take some nuanced advice from, not advice, but you take nuanced opinions from people and you formulate your own strategy. Nothing that I say or Matt says is speaking out of just creating content. And I think that's one of the discussions that I had in Finance Junkies earlier this week, is that me and Matt, even though we are creating content, that's not our primary motivation for investing. Our primary motivation for investing is making money with our investments. It's not to make money on the people watching. Because at the end of the day, if you're making money on people you're watching, you have this inbuilt thing where you're chasing views rather than chasing returns in your investment portfolio. So we are always going to try to be genuine with that. And we're just going to call it like it is, whether it's a good thing, whether it's a bad thing, who knows? It may not align with your point of view when it comes to your specific company that you're invested in. And we can have a difference of opinion. My goal here is this: pick good companies, avoid the bad ones, and see where things go after that. Am I always going to get everything right? Of course not. No one is, like, even Buffett has got a bunch of things wrong, and he's the greatest investor of all time. So if he's not like completely wrong, I mean, completely right on everything, then I can't be expected to be right on everything. The only thing that I can try to promise you guys is that I will try to get more things right than wrong. And that's what every single investor needs to do, which is try to figure out which bets are going to work and which ones are going to work in the long term for them. And just weigh everything. There's When it comes to investing, there's no one approach that just works. Everyone's got different approaches that works for them. Everyone's got different risk tolerances. Everyone's got different points in their life where they're investing. Someone who's investing in their 20s can be a lot more aggressive than someone who's in their 50s. If you're in your 50s, you have a lot less time for the market to recover before you actually need to utilize that money. So just keep that in mind. And so there's so many little things that we're going to talk about today that I think are important. But the conversation today is pretty much going to be led by a theme that what to basically do to avoid landmines. That's what I'm going to say it anyway, which is pretty much things that you think that the ground is safe, you can walk on it, everything is good, and then lo and behold, you step on one of these things and now your portfolio's poof, takes a huge hit. So how do you avoid those? How do you not fall into these traps, that are just laid around you? And that's what the market sometimes is. The Finance Junkies had a really good discussion today about Chamath and how he was promoting a lot of these SPACs, like, oh, these SPACs are like the next greatest thing. But anyone who was really like doing good due diligence, they would have looked at the numbers and said, hey, these guys don't have enough money to last the next couple of years. How the hell is this a good company to invest in? So that's where guys like me and Matt will come in and say, look, we can objectively take and look at a company and say, okay, where is this company likely to go? Is it a good investment? Is it worth the risk? I think that's the real key
Mhm.
question that everyone needs to ask themselves. Is this worth the risk? And sometimes it could be, if the price is low enough and the return is great, it could be something that, hey, maybe I'll throw a few dollars in it and see where things go. But definitely no one should be buying a significant part of a business in their portfolio that's super speculative, because that's inviting a lot of risk into your life. And unless you're willing to tolerate that risk, just like I said, just woosah and find some good companies.
Yeah, I think a good one to kind of think about is a lot of people are swinging for home runs, but sometimes you just need to get on base and get a single,
Yeah,
right? And eventually you put
yeah,
enough singles together and you're going to win the game. And I think a lot of people are sitting there trying to, point to right field or left field like they're Babe Ruth and, have never swung a bat before. And next thing you know, they end up striking out and having to sit on the bench the rest of the day. And I think that's a really good way to kind of put it. And a lot of people are like, I want to be like Chris or I want to be like Buffett. It's like, well, let's take Buffett, for example. He's been doing this for God knows how long, and he's been putting at least 60 hours a week. And he's also reading all the financial statements. So if you're
hmm
not doing any of that, don't try to be like Buffett, right?
yeah,
And I think the first thing that maybe I'll kick it off with, there's a million different things that you can look at. But one of the key stats, and maybe this isn't important, maybe it is important, but Chris, this probably hits home for you because you like to talk about portfolio drag and hedging and stuff like that. A lot of times people are like hedge fund managers or ETFs or this or that don't outpace the S&P 500, right? And I think a lot of times people don't recognize that, and maybe this is a quick point and we move on to the next topic, but I think sometimes people don't realize like hedge funds don't necessarily want to beat the S&P 500. Hedge funds want to make sure that they maintain, you know, a very flat sort of steady returns. They want to make sure, even if it's 5-6%, that they never go negative for the year, because those people that have their money in those funds, they don't necessarily care about being a billionaire or a 100 millionaire. They just want to make sure they don't lose money. And so they don't want to have a 2022 on their hands where their portfolio investments are down 30-40%. And you'll see a lot of hedge funds in that particular scenario don't go down 30-40% because they're hedging appropriately, they're putting on portfolio drag and things of the like. And I hate one thing, that might be like a hedge funds sort of example. One thing I hate is people just throwing their money aimlessly at ETFs, thinking that index funds and ETFs are synonymous with each other. Now, if you are investing your money into an ETF, please do me a favor and read the prospectus. You don't have to be too intelligent to understand or have a huge investment mind to understand. Generally speaking, these first few paragraphs of the prospectus will tell you what it's all about. And it might say specifically, this is the index that we're tracking. This is what the objective is. So, for example, if I was looking for dividend income, I wouldn't be investing in the NASDAQ 100, right? So it kind of gets you to understand. It's like, well, I'm investing in the NASDAQ 100. Should I be expecting a 3 to 4% yield? No, you're setting yourself up for failure. And so my thought process is, if you're investing some of these ETFs or somebody mentions it to you, it might be good for their strategy, but is it good for yours? And that goes back to the answering the 5 questions. My objective, my time horizon, everything is going to be very different from the man that's sitting to my right or left, depending on if you're talking about the chat box or you're talking about Chris. So I think it all just kind of depends on that piece. And somebody might be investing in a VYM, a dividend income ETF, and they need those dividends because they're 50-60, versus somebody that's in their 20s and 30s. You might still be focusing on growth.
Yep. Yeah. How does tax affect hedge fund managers and clients? Each one's going to have different tax treatment. Hedge funds have pretty much figured out how to game the system. They have like a lot of loopholes in the tax code. Some things called carried interest, and I'm not going to go too far into it because I'm not a hedge fund manager, but there are ways that you also have to take tax into perspective, like where you are in life when it comes to taxes, because you don't want to be in a position where you have all these gains you've been buying in and selling and in and out, and then you just have most of your loss. You're going to end up taking, most of the money that you're making, a lot of it is going to go to taxes. So, investing is such a well, I don't want to say complicated, but it's such like a nuanced thing where every single investment has its ups and downs, and you just have to figure out which one's best for you. But today, I think that we can start it off by just traditional metrics that a lot of people use that are basically traps. So let's use PE, because I think the first one that I think a lot of people mess up on is they look at a company and they look at the PE and they automatically assume this is a good investment. Low PE companies for the most part can be good, but the PE is only an indicator of something, and a lot of it is just valuation on price versus equity. But a lot of times what people don't understand is that PEs are backward looking, right? So if you had, like last year, your price to equity, you made a ton of money because you had a windfall of, profits on one thing. The next year, you don't have that additional money coming in. Your PE is not going to look good. So a lot of people look at the PE and say, oh my God, this is a low PE company. I'm investing in a safe company. Valuation is super low. This is great. And then the real earnings start coming in the future. And then people are like, wait a second, what do you mean? Like this, I'm losing money. Like, how is this possible? This was an undervalued company, right? And so I'll give you a perfect example of that real quick. And that is, let me put Intel, INTC, right? Intel, great company, believe it or not. Historically has been one of the most significant parts of like the economy. I think at one point they might have even been one of the largest companies on the planet. But here you can see the PE right now is non-existent, right? price per equity. And the reason for that is because if you go look at the financials, right, their income is really, really low. So they're only about 35 cents per share in diluted income this quarter. But over the last couple of quarters, they were actually losing money on an EPS side, which means that their PE was in a negative mode, right? So one of the things that I would encourage people to do, instead of looking at just the PE today, look at it historically. And I think that is a key thing that I started to look at. And it really helped because of that, I can see where they are in their growth trajectory, right? So as an example, Intel in the year 2010 was trading at a 6, 7 PE. And then, eventually their valuations, because they were growing, jumped up to about 12. And then it went up to 10, 9, 8. But you see, there are only very few times where that PE really jumped up. Most of the time, it's been sitting in this range, around the sixes, the sevens, or eights. So if you see a company's PE jump up a lot, like this spike right here, figure out why. Why did the PE jump so much in 2017 in this quarter? Maybe they just had a really good year that year, and then the price eventually followed suit and it went up, right? But then what happened was the growth started to slow down. So their earnings, you see here, started to collapse. And what happens is, look at the EPS here. They were earning $6 per share in EPS in what is this? Which quarter is this? In three, okay, in March of 2022. So looking at this, you're like, wow, they generated $6 billion, $6 of earnings per share, and their PE is only a 7.8. This is amazing. This is a great company to invest in. But if you looked at their business was actually deteriorating, right? And that's when you see the year after year over year, their EPS started to just climb down and go down and down and down. And now that low PE that you thought you were getting was actually the top of the market. And that could be something that's a bit of a trap. So a lot of people bought Intel around let me see, MTC, thinking that they were getting a value company right here, right? That they were getting a value company, and all you saw was a nice descent down. It's been slowly rising since then.
I don't
But
think
that's
you're sharing.
sorry. Yeah. Prices. Let's see.
There we go.
Now, over time, look at this. If you had bought, you would have bought in the 47.50s right here when all those things were happening. So right around here, 45, you would have literally taken a huge drawdown to about $29, $30 a share. And now it's recovered slightly, but you would have taken a huge drawdown of about, what is this, from 50s to around 45 to like 30. So that's a 15%, a $15 drop, which ends up being like 33%. And then on top of it, just another kick in the nuts, Intel was a dividend player, right?
Mm-hmm.
So Intel used to have a really nice dividend. So some people thought, well, it's okay, I can tolerate the PE. Let me just, I'm getting my dividends. Well, the problem is, if the business does not do well and the cash flows start to go down, that means that there's less money available to pay that dividend. And
Right.
so eventually that dividend gets cut. And that's what we were talking about earlier, which is some people invest in companies looking purely at the dividend and saying, wow, this is a really great dividend. But the thing is, it's a fucking trap. Don't just look at the dividend. And then what happens is, the business can't support the dividend. They start cutting the dividend. And then people are like, wait a second, wasn't I supposed to get this dividend last quarter? It's like, no, that's the fallacy. Dividend is only paid based on profits. Well, sometimes they'll take on debt to pay dividends too, which is what some companies do, but that's even worse. Any company that's taking on debt to pay dividends, run.
Yeah. But that goes back to, are you fully doing the due diligence, right? Say a company is giving out 5%, and like it's a Philip Morris or an Altria Group. They might be able to afford it, right? So, if they're making that much net margin that they're giving back, you could have something called a payout ratio, and you could see how historically, is the payout ratio, are they overpaying? Are they paying out more than they even earn? You have to know, you can't just say PE, right? You have to triangulate on a multitude of different factors. Then just PE. And another example that Chris probably is familiar with is investing in cyclical stocks like commodity stocks and stuff like that. So 2022 was a banner year for energy. And so you saw that theme in the beginning of 2023, people continuing to invest in energy stocks. Now, let me just give you a quick rundown, and you'll probably think, in retrospect, everything's 2020, right? But oil prices went up above $100 a barrel in 2022. So obviously earnings for a lot of these oil and gas companies started to do really, really, really well. So the PEs that a lot of these companies were trading at were low to mid single digits. And so everyone's just saying, oh my God, like I should invest, right? It's so cheap. Compare that to, let's take Shell, for example, made 50, $60 billion in cash flow from operations. That's comparable with some of these tech companies that are trading in the trillions, right? Meanwhile, Shell was trading, I think, about $200 billion. So you're like, man, you think about it, it could 5x, 6x if you're just comparing, the price to earnings and compare it to, say, an Apple or a Google or something of the like. Lo and behold, oil price now is back in the 70s, $80 barrel range and closer towards that break even. And so that price to earnings that was, say, low single to mid single digits is now probably in the order of $8 to $9, or sorry, 8 to 9 price to earnings ratio. So a lot more representative. But then you'll also get to the point where oil price goes negative like it did in 2020, right? And there's not a price to earnings in sight. So you have to recognize where in the cycle some of these companies are, right? Are you at the end of a big cycle for people buying cars or homes, or all like BHP is another good one as well. Where are you in terms of the cycle for commodities? Is it trading at are prices really high right now? And eventually they're probably going to come back down, because that's what ends up happening. Commodities go up, recessions happen, commodities come back down. So you have to kind of recognize where a company is in its sort of cycle, specifically if you're looking at a commodity stock.
And some industries, they have this tendency where they become the hottest trend of that year, and they just ride up like crazy, and then once like the people realize that maybe this isn't the greatest thing in the world, they take a drawdown. So let me just give an example. I'm going to give not Intel, Nvidia as a good example, because over historically, if you were an investor in Nvidia, you would have killed it. Like literally, look at this, right? Killed it. But over time, there are actually moments in Nvidia's history where they actually drew down so significantly that it really sucked. I mean, a lot of these, all this stuff is adjusted for splits and stuff. But if you think about investing in Nvidia in 27 and '07, it went back down all the way to like fours technically based on the adjusted return. So if you think about it, if you paid something that's $8.47 and then it goes down to, let's say, oh, right here in 2008 it went down to $3, that is a lot of red that you're going to see in your portfolio all at one time, right? And it happened again where there was a spike here in 2011 from, to 5, and then it went back down to like 3 something. It happened again in 2018 where it went to $70 and then it drew back down to 36. I mean, literally, you've lost. If you bought at the highs, you're going to literally sacrifice the next few years just to get back to that high again. So, I mean, Nvidia is one of those companies where it'll always, I think, in my opinion, get to a point where they'll be able to capture the alpha eventually. But cyclicality will affect this company significantly depending on when you buy it. So, like if you bought at the top of the market in 2018 at $70, you didn't get break even until, what is this? Or until like probably 2020, like 2 years later. Then the same thing right here in 2021 of November, when all the crypto craze was around Nvidia, their GPU chips. Because of AI, Nvidia was able to come back, and they ended up coming back 2 years later. But that's the thing that I have to ask people, like, with the current rise in Nvidia where it is today, is there still a lot more room to go up? I don't know. But I can tell you, if let's say the industry ends up pausing and it doesn't like do exactly what Nvidia is like being priced for, it's going to be a lot of years before you're going to be able to capture or at least get that money back, even if you have a wait and hold strategy. And I think that's one of those things with like Cisco. A lot of people, they bought Cisco in the year 2000 during the dot-com bubble, right? And literally went to $74. It's never come back to its all-time high. And it's been what, 23 years since then, right? So this is where you have to be very careful, even if the company seems like it's super revolutionary, it's the next big thing. Keep things in perspective. Um, Understand that the value that you're paying for it today may be excessive, and that it will eventually get to a place where the valuation makes sense, but don't overpay for them for that company today, because if you do, you're going to end up in a bad place. you know
So I wanted to highlight specifically about this because this is kind of also part of the trap that people get into. Like people have been giving me a little bit of, not a lot, but most people are very receptive of the DD that we were kind of doing on Dutch Bros and potentially getting into it. And you are buying a very richly valued company at the moment if you're buying Dutch Bros here at a $5 billion market cap. If you think about it, and a really good one about it as well, which Chris I think brought up on Twitter or X, was Chipotle being very similar for a very long time, trading at a very expensive ratio. And this goes back to, not just looking at price to earnings, right? It goes back to how quickly is that company growing and where do you think they will be in the next, say, 5-10 years. And this is also some of the risks that you have to look onto as well and be up to speed with the earnings calls. A very good example of this is Palantir and a lot of other people, like, and getting upset at the slowdown in their growth, right? And understanding, is it even make sense now for the valuations that are currently being paid for the market cap? So let me go back to Costco, for example. If you have Costco memberships exploding at, say, 20 to 30% per year, and the net income on that you're getting is a margin of, say, 50% or something like that, over the course of several years, you're going to see a very fast growth pace in the net income. And so the 1 year, let's just take, for example, let's just say Costco back in the 90s wasn't exactly profitable as of yet. And they were just kind of getting their infrastructure set up and stuff of the like. They just hit profitability, right? So they're just making 1 cent earnings per share. Of course, it's going to be trading at a massive price to earnings because they just hit profitability. It's the same sort of situation that Dutch Bros is in right now. Now, if they continue to grow at 30 odd percent and their margins are really good, that net income is going to grow at a pretty expansive rate because now they're already paying for a lot of that underlying operating expenditures. Now, if they continue to grow, say 20, 30%, and their net income continues to grow at a very expensive rate. Exactly. This is exactly what I'm talking about. Revenue grew at 30 something percent. The net income grew by 400%, right? And so you're going to see something very similar going forward, where that net income is probably going to go into the 15 million, the 30 million, the 40 million over the coming quarters. And it's going to grow into that price to earnings very rapidly. Chris, I'll hand it off to you. I don't know if I'm saying anything out of line here. You're on mute, my guy.
when you're looking at a company like Dutch Bros, like that's growing really fast in terms of like the business, it's one of those things that what ends up happening is that the numbers will of course be a little bit like, how do I describe it, like a little bit jarred towards like the upper end of things, because people are recognizing this. We're not the only ones looking at this. Hedge funds, other Wall Streeters, they're looking at it, bidding up the price on this stock, right? So is it right time to get in now versus, hey, should I wait until the valuation comes down? And the thing is, the valuation sometimes never gets down to a point where it's actually investable based on just a true undervalued PE metric. So this is where you have to really like ignore sometimes the numbers a little bit. I mean, of course, keep an eye on the numbers, but you have to ignore the traditional metrics like PEs and instead focus on the product, right? And once you focus in on the product, you can actually see that accelerated growth. And that was something that was actually kind of impressive today on Twitter, where you brought up Dutch Bros and some people were just like, oh, like it's overvalued, blah, blah, blah. And then someone wrote in a really cool comment, said, Listen, there's a Dutch Bros around the corner from me, and every time I go, it's freaking packed.
Even at
You
8
know,
p.m.
even at 8 p.m.
Yeah.
It's just think about that for 2 seconds, right? That is the key to sometimes investing, which is there is a trend happening that may not be visible just based on the pure numbers. But if you look at it, like Nvidia, right? Nvidia, everyone who was using AI and GPU chips in November were probably like, hey man, I can't get these chips anywhere. And the cost that I'm paying to Nvidia is like crazy. They had some insider carnal knowledge of this industry where they're like, oh, AI is the next big thing. Nvidia provides the chips. Screw the PE. Let me just buy the stock, and then it just rose up like crazy, right? So it's the
Mhm.
same thing with like Dutch Bros. Like this is one of the times where you have to take numbers into perspective, which you should always do, but then also look at the product. Is the
Yeah.
product growing healthily? Does it have repeatable business? Is the
Yeah.
quality of the product something that's going to keep going? And at the end of the day, you look at companies like Starbucks and stuff, all they're really doing is like selling sugar water. The margins
Mhm.
are super high. The thing that Dutch Bros is doing right now, and the reason why some of the metrics like free cash flow is not there is because they're taking all of their cash flow, redeploying it back into the business to grow their business to get more stores. And
Mhm.
eventually it's going to come to the point where you as a shareholder are going to be holding a company that's going to have 1,000 locations and then 5,000 and then 10,000 locations, and
Yep.
every time someone is drinking that cup of coffee, you are getting paid because you're a you're part owner of that business.
Right.
So a lot of times people, it's so funny. Streamlabs the damn
The
bot.
Streamlabs has no chill. I need to edit it, but going back, I want to
Yeah.
build on that because some people like s- Dutch Bro's been around since 92 or 93. So I mean,
Mhm.
eventually they originally had a profitable store, and what probably ended up happening, and this is something to kind of think about. They probably said, you know what, this is scalable. We could go nationwide with this. So they go public. With being public, they're able to then get some money for additional stores, and they say, you know what, we're making so much off of some of these stores. We have a run rate of say 5-6 years where we can invest to a point where if we just invest however much money, we can get to a point where our EBITDA will be enough where we can open up 150 stores a year. And they're not far off, right? We talked about this the other day. And so it gets to that point as well. Like Amazon was at that point where, they were obviously making a lot of money selling books online. And then they said, let's take on some additional money to be able to invest and start selling other things like, eventually now where they're selling things literally through Whole Foods. So you have to recognize, a little bit about something's trading at a 30 price to earnings versus a 15 price to earnings for a different company. They're not going to trade the same, as always. Like a Google trading at a 22 price to earnings to some people might seem expensive, but you have to recognize Google and how quickly they are growing versus a Altria Group, which is trading maybe at a 10 to 15 price to earnings. Their revenue is barely growing at all, and they have litigation problems, and they have all these other things that can be a hindrance on their forward earnings income potential, and they're not innovating anything. So you have to recognize something with a price to earnings at 10 isn't necessarily always going to be comparable to something with a price to earnings at 22. Now, let's just say, for example, Nvidia was trading at a price to earnings of 50 last year, and now they just had this explosive 200, 300% year over year earnings per share growth. Now their earnings per share, their price to earnings is now grown into a valuation where it makes sense for it to jump, say 20, 30% overnight because of the fact that they've been able to hit this market where people are really getting hyped up about it. And so it kind of goes in that wave of what Chris was talking about earlier, which is crypto was a big thing during this time, and then they pull back a little bit. Then crypto was big a second time, so GPUs were selling like hotcakes. Excuse me. Now you have this AI wave. What we're trying to say is there's so like that's what makes the market the market. There's people that are day trading the stock. There's people that are buying and holding. There's people that are speculating. There's people that are literally just buying the shares for liquidity so that you can go sell options against it or go like the market makers of the world that they're just trying to make little fractions of pennies. So you have to recognize is that every single stock is a culmination of all these people all in it at once. And so there's no right way or wrong way to be able to trade these positions. All you can do is see if it makes sense for you and your portfolio. So just like how if you're looking for dividends, you probably wouldn't be investing in Google right now, right? But let's just say for me, I'm trying to get to the 8-figure mark and I have a way to go. I shouldn't be investing in Altria Group because Altria Group's is going to pay me a 4 or 5% a year dividend, and they're probably not going to grow all that much. So it kind of gets you to think, where are you putting your chips and why are you putting your chips there? And it goes back to the kind of the thought process you were saying about Google. Google might have seemed expensive at a price to earnings of 30. And I remember thinking the same exact thing back in 2015 and 16. And it went up a little bit. I made like 10% and I sold. And that was like when the stock was at 100, 150 bucks, something like that. Well, I didn't really
pre-split.
Did it split recently or?
No. I'm saying when you were talking about 2015, it split from 2015, 2016.
Oh, did it really? Did it's up $600 again? Jesus Christ. Yeah. So anyway, it goes to show you, like, are you doing your full due diligence on these companies? Because let's just say you're taking an opportunity in Dutch Bros and you say, oh shit, I doubled my money. And it's like, well, if you think about it, they're going to open up 4,000 stores, right? They're at $1 billion in revenue now, 4,000 stores. They're going to be making about $7 to $8 billion a year in revenue. What's that going to equate to in income? Is it going to be 2 billion, 2.5 billion? And if that's the case, what multiple are they going to be trading at? Are they going to be trading at a 10 multiple where they're worth then 20 billion, 25 billion? They're going to be trading at a 20 multiple where they're going to be worth, say, 40, $45 billion, right? It all goes back to kind of that thought. And that's when you have an earnings call and it misses and revenue doesn't grow at, say, 30%, it grows only at 20%. Why you see the stock down 20%? Because now, like Palantir, people are seeing, oh shit, it's not growing at a 30% year over year like they said that it was. So it's not going to meet its trajectory. So in reality, if I'm buying it at this price, I'm buying it at a 15 times price to earnings in 2028. And I thought I was buying it at a 15 times earnings in 2025. You're like, I'm not going to wait until freaking 2028 for the stock to be that cheap or grow into its valuation. So they sell it, and everybody sells at the same time. That's why it's down 20% in a day. Chris, did I say anything wrong there?
No, you're right. The one thing I want to also highlight is that sometimes businesses have this tendency where they can go into the wrong location, right? Or they can overspend on things themselves. It happens. Like, look at Google right now. Google, they on a free cash flow basis, look at this. They've in 2022 March, TTM, which is 12 months trailing, they were doing about $70 billion in free cash flow. Okay, this is Google, 70 billion in free cash flow. So if you look at the stock, what happened to the stock? It was up to almost, I think, $150 a share at the time, right? What happened is they overspent on a lot of investing, on side projects and everything else, but now they're course correcting. Now, one of the cool things is when businesses course correct, that ends up showing up in their numbers. So free cash flow, look at this. Now, based on last quarter's TTM, their free cash flow is actually excess of what they were actually generating last year in March with all the AI cloud behind them. So that all that stuff is going to be literally like a wind in Google's sales, pushing them forward, and their free cash flow is just going to keep growing. Look at this. Now it's got a $71.1 billion free cash flow number on a TTM basis. But if you go back to March, right, when it was at its all-time highs, let me just pull up Google's chart real quick. Look at this. It was all the way up to $150 a share at the max valuation. So this is where, if you really just pay attention to the businesses and their numbers, you can see that this actually should be closer to a much bigger to a much higher valuation than the $150 that it's trading at currently, right? So, like I said, once you do some math, you just try to figure out what the business is doing internally. These things are not that hard to figure out, and Google is one of those companies that right now is doing a lot of soul searching in terms of making sure that they're operating profitably because they've been called out by Microsoft, and also at the same time growing their cloud business. And then there's so many tailwinds behind Google, and they're doing share buybacks. Think about it the other way. The last 2 years that Google was down, Google was actually still doing another thing, which was they're taking their own income that they were generating and putting it back into the business via share buybacks, right? So if you think about the share buybacks on our free cash flow base, you got 2 years worth of share buybacks that just happened, which is about $120 billion. That's $120 billion of less of a pie that Google shareholders today are going to be, what do you call it? Basically, they're drawing from a smaller pie than 2 years ago because they've had 2 years of growth, but yet they're paying less than what they would have 2 years ago. You know what I mean? So from a valuation perspective, Google is highly undervalued. And that's why if you look at a lot of this is a great thing to bring up. If you're ever unsure about companies, like, oh, is this a good company or bad company? Find out what's going on with the hedge funds, these institutional holders. Are they adding to the positions? Are they subtracting those positions? Because if you understand where they see future profit and potential, you can actually ride their coattails. And I have no shame whatsoever in riding their coattails. So if you look at Ray Dalio, Ackman, they've all been buying Google, so it's part of their portfolio. So look at their portfolios and see what these guys are buying, because if you can aggregate all the data, take the top 20 institutional investors like hedge funds, not like the BlackRock and these guys that like are just index investors, but really core investors. Take about 20 of them, even 100 of them if you want, and look at their portfolios and see which companies are actually in their portfolios, and then use that as a benchmark and say, okay, look, last quarter, out of the 50 hedge funds that were out there, 30 of them bought more Google. I think Google is going in a certain direction. And if you see the opposite thing happen, where 40 of them or 30 of them sold out of Google, then it's maybe something to worry about also. I'm not saying that you should invest like them, but if you take aggregated data, it might give you a better understanding of where the institutions are moving their money. And a lot of times the people that can actually move the markets are the institutional guys.
So I bring up AutoZone. Chris is probably sitting there like, why the hell is Matt bringing up AutoZone? But you probably know, maybe you don't.
Yeah.
So let me ask you a question, Chris. Do you think that AutoZone, from the time that they IPO'd in the late 2000s or early 2000s to now, grew their net income by 80x?
I don't know. I never.
The answer is no. They did not. They haven't. Okay, so I'll cut the short answer. So they did not. Yeah. Okay, so this is a perfect example of buyback. So let me explain to everyone in the room a little bit about why this is important. Okay. So they actually increased somewhere around the lines of like 8 times their net income from the early 2000s to now, right? So you're probably sitting there like, okay, so why did they 80x, right? Well, and this is a beautiful example of what Chris is kind of talking about with share buybacks, which is they bought back so much shares of AutoZone over the past several years that this is a perfect example. So keep in mind that they went from, say, making $1 billion to $8 billion, right? Now let me share this important piece of information with everybody. Sorry, I have the hiccups. Where they had 120 million shares outstanding, that 0.12 billion, to now having 20 million shares outstanding, right? So the amount of shares that they have bought back is about 85% of the float in the same time period. So take that 85%, which 1 divided by, what is that, 0.15? That gives you a 6, almost 7x right there. And then multiply that 7x by the fact that you increased your net earnings by about 8x. And that gets you to 53 times, right? Yeah. So there's obviously a little bit of wiggle room with price to earnings and when you're dealing with such a low number, right? But just by saying we grew net earnings by 8 times, and then you bought back 85% of the float, which is basically reducing the share count by 7-fold, then you can then start to multiply the numbers and understand why you only increased that income by 8 times, but the stock is now worth 80x more than what it was. So I don't think people necessarily.
It's so funny. I never even saw this, man. Can you share my screen real quick?
Yeah.
Holy shit, man! I had no idea that they were share the screen. Look at this. Look at the amount of cash flow. This is all their cash that they're generating, that they're literally buying back shares. I had no idea
Yep.
that they were buying back so much in stock, man. That's nuts.
So when you hear about people
Look
talking
at
about
this.
buybacks and stuff like that,
Yeah.
generally speaking, it's very much loved by the BlackRocks and
Mhm.
Vanguards of the world because they don't
Yeah.
ever sell, right? If it's a company that people are going to continue to have on the NASDAQ 100 or the S&P, they're always going to have a position in it. So who are they buying back the shares from? The idiots like you and me who are selling the shares, right? That aren't buying and holding. And so if you have these companies, so that's an example of a perfectly executed share buyback. Most of
Yeah.
the time, it doesn't end up that well because most of the time you have so much share dilution going on, or the company's
Yeah.
not doing well. So then they'll issue shares to go buy another company. And so a perfect example of this is oil and gas companies where they buy back a bunch of shares when they have the money and then they issue more shares to go buy another company and then they fluctuate all the time. But what you're seeing is probably a good example is Apple. It's hard to track Apple and it's hard to track Amazon and Google's as well because they keep splitting the shares.
Mhm.
20x for Google recently. Apple just had a 7-for-1 split not too long ago. And so when you look at it over time, you're like, oh crap, right? You can barely track it because it just goes up by 7 times and it basically dilutes. But if you go back to the way that you're looking at it, which is how much are they buying back in shares every year, you can kind of understand the kind of frame that you're kind of thinking about. But anyway, I
Yeah.
don't think people recognize that.
And it's funny because if you look at Apple on a split adjusted basis, let me just show people. If you bought in 2009 Apple, okay, it wasn't $3, okay? It was a much bigger number, but it split, and because this is a split adjusted chart, you could have bought Apple for technically about $3.63, and that $3 would have turned into $180. So this is how, when companies buy back shares and they do reverse splits, you're on like another level of making money. It's crazy. Yeah. Hey,
Chris, I have a
Matt, I gotta
question.
leave a little. I gotta leave a
Oh, okay,
little early today.
no worries, man.
Yeah. But what's your question before I go?
I was gonna say, do you have any opinion on like TSLY or any of these covered call ETFs or anything like that?
To be honest with you, I
If you don't know, that's
I
fine as well.
I try to do the math in my head to figure out whether it's a good investment or not, but it doesn't jive with me. Like, I think sometimes, yeah, I don't know. I don't know enough. These are a lot more newer products. I don't know. There's no historical way of going back and seeing how profitable these things were, because essentially all you're doing is just selling covered. They're doing is selling covered calls on your behalf. But sometimes it actually makes more sense just to buy the stock and not take the capital. I mean, not take the dividends, then have to pay taxes on them. So I don't know. I have to do more research on it.
No,
Yeah.
that's fine. And if you feel free to head out, and I'll
Yep.
catch you
All
next
right.
week, man.
Later, man. Take care.
Later, brother.
Bye.
So I'll see if I can have a good opportunity to give a good look on what's going on here with respect to TSLY and Tesla, and I think maybe comparing the two over the past few weeks or so can really help kind of explain whether or not it's something that you should potentially look into as an investment. So let me just double check that I'm sharing. There we go. So this TSLY, for example, looking over the past 6 months, if you were to specifically looking for growth over the long term, just demonstrates why it's probably less prudent of you to go ahead and buy something like a TSLY, right? If you were to say, look at where we are over the past 6 months' time, there's a divergence in the actual share price of about 30%, right? So on Tesla, you're up about 12%. On TSLY, you're down about 20%. I know this is kind of picking specifically, but you can do it at the beginning of the year or two. I mean, whatever makes you happiest, right? I mean, let's just do that. So it's a year-to-date comparison. You're up 100% year-to-date on Tesla, and on your TSLY, you're up 1%. So you have diverged 100%. So if your goal is growth, then to me, buy the shares, right? The thing that I think a lot of people are thinking about, they want their cake, they want to eat it too, to the point where they go ahead and they buy a TSLY because it's showing a 30% yield or 20% yield. And so that's okay. I get it. But at the end of the day, a lot of times you're going to get beat up when it comes to investing in a TSLY. Once again, if you're looking at a year time frame, you diverge, say 55% or so. It makes you think, it's like, is it the most prudent thing to kind of be doing? And I guess it just goes back to what fits in your investment strategy, right? I mean, if you honestly think that 30% yield is going to be good, I mean, it could over time be something that keeps up slightly with a Tesla. But you have to think, Tesla's a very volatile being. And so what you've noticed is, let's just take like the last few weeks, or last week or so, back to it. So their Tesla was at 215, now it's at 230. So it basically went up, what is that, about 8%, versus this only going up about 4%, so half as much, over the course of the same sort of slight run up over the past few days from August 18th to now. So yeah, you might be getting that monthly dividend, which, to you might be that great drip. At the end of the day, it really all just depends on like what you're going after. And the same thing with, say, some of these covered call ETFs. Now, I'm a fan of these as well because I think in the long run, they have enough of staying power through cycles where you're going to be able to kind of get out of anything in terms of, say, principal loss over time. Uh, but these, you have to think, let's just take since 2014, when QYLDs of the world were kind of brought onto the market, you're down 30 odd percent, because of what happened in 2022 to now, versus up 300% or so, in the NASDAQ 100. And so you could sit there and say, well, over the past 10 years or so, I've been able to capture 10% yield. And so therefore, I'm up 70% overall with my QYLD. I get that and I hear that. But then also, you have to think, if it's not a tax deferred or a tax advantaged account, generally speaking, these are taxed as ordinary income, or a large portion of them will be taxed as ordinary income. Now, I'm not saying that's a bad investment. It just goes back to understanding what your objectives are. People might be trying to sell these things just for views, and they might not have your best interest at heart. I know plenty of people, and in fact, I was blocked by someone yesterday or the day before who preached specifically dividends and dividends only, trying to prey on the people that aren't educating themselves because they don't want to educate themselves and create content in order to collect views. Now, if I was all about views and I was all about money, I've been doing this for 6-7 years on YouTube. You can see I have hundreds of videos where it's mostly just me going over my dividend income and stuff over the like. You can see I made my mistakes in 2015 through 2018, focusing specifically on dividend income. And I realized I matured over time and realized that that's not the only way to invest. It's a way to invest. And in fact, if you're close to retirement, I suggest dividend income being something that you consider. But you think about it, I would much rather have a dividend yield on my portfolio of 2.5 to 3% and guarantee that it stays there than a 10% or 15% dividend yield that I can't guarantee stays there. Now, it all goes back to, what are your income needs and how much money do you need? To me, I hope to have a portfolio yield of 2.5 to 3% and a portfolio size where it supplies me enough of, say, $100,000 to $200,000 a year. That requires a lot of capital, and I get that. But I also would recognize as well that you can make up for shortfalls doing covered calls and other items out there where you can make up a little bit of extra income as well. And so there's no one size fits all sort of situation. And I think a lot of times people go to this TSLY, for example, and they think, okay, I'm going to be able to get the returns of Tesla and get that 30% yield. And it goes back to understanding and looking at the prospectus. Now, let me just look at the prospectus from Yield Max. And maybe it'll help you kind of understand what I'm talking about when it comes to these actual like things that I'm describing. Okay, we're still on the same screen here. So let's read the prospectus here. Yield Max ETFs. Womp, womp, womp. Fund summary for Tesla, 92. Did it go to a different? Okay, it did. It did not go to that. So let me reshare. There we go. Okay. So management fee, 1%. That's kind of understandable. With respect to that, the fund's primary objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of the common stock of TSLA or Tesla, right? So first income, second, follow Tesla's share price. So let me ask you if what you think they're going to do and what matters most. It's not to track Tesla stock first and then pay an extra income on top of that, right? It's get you income and then focus on getting you a little bit of following of Tesla. Now, what do? The use of Tesla options contracts. In general, an option contract gives a purchaser the option contract the right to purchase for a call option or sell for a put option, the underlying asset like shares of Tesla at a specified price. So what do they actually do here? They sell a synthetic covered call strategy. Now, if you don't understand a lot of this stuff, this goes into understanding maybe you shouldn't be investing in these things in general, right? So generally speaking, what does this mean in terms of the covered calls that they're writing to generate this income, right? So they're writing at a strike price that is approximately 5 to 15% above the then current Tesla share price at the time of such sales. So what does that mean? That means that in a given month, if the share price explodes 100%, you will be capped at 5 to 15% because the covered calls are forcing you to sell that because they are seeking income first. Oh, crap. You can't see it. There you go. Thank you. So I was looking specifically at this covered call piece and how they're looking at 5 to 15%. So if you're increasing at about 100%, that's the deal. I mean, you're not going to be able to get that 100% return because you're focusing on the income, which is selling at a covered call price of, let's just say 5 to 15%. So let's just take this for example. Let's just say the shares of Tesla right now are uncovered, and Tesla, let's just say it's trading at 230. So I think it's trading at about 230. So that means today they'd be selling covered calls at $241 or $264. What happens if it jumps back to $300 a share tomorrow, right? You're going to miss out. And so exactly like what ends up happening when you go to the share price graph, let me get it back up in here. You're seeing that you're not recovering as much when the stock is actually doing relatively okay, right? When Tesla's skyrocketing back up, you only go up 4.5% instead of the 9% that Tesla is actually able to go, right? That last little bump here is what I'm kind of referring to. The other day, it dropped down to 215 a share, 210 a share, and it jumped back up into the 230s, which was a 9% jump versus what you're seeing here is a 4% jump. So with respect to that, just kind of keep that in mind. Like, is that okay? Is that what you're looking for? So I just wanted to highlight that a little bit and give you guys an idea. You know, not saying that it's not the right thing to do, but it's just recognizing what you're getting yourself into. And that goes for all ETFs, right? Are you doing the right thing by doing it, right? By investing in that ETF. So let's just see. When you're young and low income, go for higher dividends. What? Safe ones like TFC, for example. I don't get that 100%. But anyway, unless there's any sort of questions, I might just end it here. Hot Chris had to leave, understandably. Been running him ragged all week, so much appreciated. If you guys haven't already, do me a favor and subscribe to Hot Chris's Patreon. The link is in the description. And as always, it's appreciated you guys continue to like and share the videos as much as you can. And also subscribe to the channel if you haven't already. But I'll stick around for another minute or two. If any questions come through the chat, I'll be more than happy to answer them. But otherwise, it's been a great week hanging out with you guys. And as always, we're really just trying to add education here. We're not trying to hype anything up. I appreciate there's already a very, very good channel and group of guys that do that. And Chris is involved in that as well. Finance Junkies has a really good entertainment factor to it, but sometimes they skip over something that is extremely necessary, and they focus too much on the hype. And like I said, great entertainment, and I think that it's a great opportunity for folks to continue to cultivate a great culture. But at the end of the day, hey, I'm seeing some names I've never seen before. I really appreciate you guys coming out, and hopefully you guys are getting a lot from the show. As always, there's a lot of different ways to kind of understand what what way you want to invest, and sometimes that hype just hits you in the right spot. So, any opinions on SCHD long term? SCHD a year or two ago had some really high quality companies in it, and it goes back to how some of these ETFs are run and understanding, what companies are in it, keeping track of them, and stuff of the like. The thing that SCHD did is they brought a bunch of companies in like early 2023 that I personally would not have brought in to a dividend focused long-term fund. Companies that I think sometimes didn't even pay a dividend have now entered into SCHD. And so for me, it's just a little bit iffy. For me, instead of doing some of those, what I'd rather do is, and they don't generally have too much of a dividend yield anyway. It's not like you're getting a 5% yield. Is I'll just invest in the SP 500 or write covered calls. And yes, it takes a little bit more time, but yeah. So I do want to get back to LMNOP's question as well. But the risk factors on things like JEPI and Tesla or TSLY are very much the same, right? JEPI's not as exposed because generally speaking, you're not going to have this big 10 to 15% movement within a month or two. You can see it, but it's not generally as volatile as, say, a Tesla. So JEPI as well, I think, is a little bit more relaxed on how close they write the covered calls. But take, for example, like the XYLDs and QYLDs of the world, they don't give you much. So I think they're sometimes like 1.5, or 2% above the money. And they're trying to generate 10 to 12% a year. So about 1% a month in income. And when the market goes down, the share price goes down with it. And so when it comes back, like say, for example, what happened during the pandemic, the market dropped 30% and it skyrocketed back up within the matter of 6 months. So you had a 60% move down and then back up over the course of 6 months. And you have a covered call ETF like that, it can't function in that sort of environment because here you are dropping 30%. Now you have to wait so much time because you can only go up at a certain fraction at a time. Now, if you have a very slow and steady upward right market, there's an opportunity for you to kind of do a little bit better on those opportunities. But if you have something that goes up, say 5% in a month, you're not going to be able to capture that entire alpha. So keep in mind that there's other opportunities other than, say, JEPI or an XYLD or QYLD. I like JEPI and Devo to a good extent, but they've somewhat underperformed as of late. And I think a lot of that has to do with the underlying stocks that are within the position themselves or the ETF themselves. But I like something called XYLG, which is more of like a 50-50 growth slash, and by I say growth, I mean it's just uncovered and covered call ETF. So when you think about like XYLD, it's 100% covered, meaning that they take basically an underlying S&P 500 index and the right covered calls on it 1 to 2% out of the money to be able to generate that income. Instead of in an XYLG, they only cover, say, 50% and they leave 50% of it uncovered. And a good thing that I'll maybe show you guys, and then I'll hop over to LMNOP's question because I think it's a really good question as well, is XYLG compared to XYLD, and I know it's not showing right now, so I'll pull it up in a second. So let me share here. So this is XYLG in the blue compared to XYLD. And this is over there, I think it's XYLG has only been out for a few years, but you can see that it's able to kind of keep up when the market's kind of rocketing up. And at the same time, it goes down just as hard because the underlying is the same, right? So you're still investing in the S&P 500. So the underlying from 2021 to mid 2022, 3Q 2022, you still had that large drawdown, but you're able to outpace during times of bull markets because you're only covered on 50% of your position. So in this case, you're up 6-7% since 2020, since the inception of this fund. Now, if we were to say compare an XYLG to an S&P 500, which I think I'm sharing. Hopefully, I'm not sharing. Oh no, I'm sorry, guys. Let me go that again. Let me just share this and kind of show you guys what I'm kind of talking about. So comparing XYLG to the S&P, you're seeing, in that time period, you're only up 6-7% for XYLG. You're up 31% for the S&P. Granted, yes, you're also getting an income from XYLG as well, but you can kind of see the divergence there. And you can see during bull markets, SPY is generally speaking outperforming the XYLG counterpart there. The piece that I also want to highlight as well is how quick and how uniform they're kind of following each other in a downtrend in, say, 2022. And then the same sort of thing happens. They kind of bottom out. And then SPY increases at twice the rate almost as, say, XYLG. So I like XYLG because it's only 50% covered. But now let's cover what happens when you, say, have an XYLD. And this is what I was showing in the background, but unfortunately I wasn't sharing as of yet. XYLD is in the red. So this is 100% covered call ETF. Since 2020, granted, this isn't March 2020, this is October 2020 to now, you're actually down on the entire position 11% because of this drawdown that we had in 2022. And it hasn't been able to recover as much. Granted, the bull run that we saw was like 20 to 25% in the SPY. And here you are being down about 15%, 14%, 15%. And I've only been able to recover 3% over that time period for XYLD versus being down, say, 6% for XYLG and now being up 6%. So if you were able to add SPY onto here as well, I think you can if you're smart enough, which I'm really not that smart. But so we have XYLG. Let's get XYLD on here. Let's get the trifecta. And then let's add SPY. Then let's compare year to date, kind of where you're at. And this kind of shows exactly, let me just double check that it's showing. Okay. Showing exactly what I'm kind of referring to, which is they're all starting year to date, Jan 3, 2023 at the same pace. And you kind of have this XYLD in this yellow, which is barely break even for the year. And then you have the SPY, which is up 14%. If XYLG was in the middle, which is about 8% up. Now, keep in mind, this XYLD is also paying an 8-9% dividend. So, you're getting about, let's just say at this point, 8 months through the year, 5%, 4 or 5%. So the total return of this would probably, for the yellow, would actually be in the order of, say, 5-6%. The blue, which is 8% up, would probably have about a 2.5% yield over the last, say, 8 months or so. It's probably 4 or 5% total yield for the year. So let's just say that would probably be 11, 12% or maybe 10, 11% at this point through the year. And you have the SPY, which is up 14%, and that would probably only be up 1% in terms of the dividend that you're getting. So 14 to 15% is about where you'd be. So you'd see, even with the dividend returns, keep in mind, you have taxes and stuff associated with that. You can't necessarily 100% guarantee some of that stuff. So hopefully that was helpful. But I think that an easy way to kind of look specifically at whether or not a company is sharing or buying back shares or something of the like is to just one, look out for it in their investment presentations, listen for buybacks. And then let me just say shares outstanding for maybe let's just do Cisco because we talked about Cisco earlier. And let me share my screen. That's the wrong screen. And then I'll probably end it there. After that, maybe I'll answer one or two more questions if there's good ones. So here's kind of Cisco. You can kind of see, okay, here they're buying back shares. And then if you were to go to, and it doesn't really help with companies that have shorter time horizons, like let's go to Palantir. I don't know if Palantir is going to work on here, but Palantir shares outstanding. All this does is it really just looks at, so you can see Palantir has been actually diluting shares or giving away too many shares. And let's look at Google. Google might be difficult because of how many shares outstanding, and they just did a share split as well. So it's hard. So if I were to be able to zoom in on here, but what you can see is the growth here. So unfortunately, when you do a stock split, 2-for-1 stock split shows up as 50-odd%. So they did another stock split here. So if you don't do stock splits, you can see they're actually expanding about a 1 to 2% a year. And then up until about 2018, 2019, they started buying back shares to the point where it actually made sense. Here they did a 20-for-1 split. So that's what that 1,800% is. But you can even see, you probably can on this scale, but they went from about 13 billion shares to 12.9 to 12.7. So they're buying back shares for sure. Now let's look at Apple. Let me just double check that I'm sharing my screen. Okay, I am. So let's look at Apple market cap there. Let's see shares outstanding. You can see the sawtooth, right? So there is the stock splits in here. So obviously you're increasing share count quite a bit when you're splitting the stock a good bit. But you can see that they're buying back stock at a pretty aggressive rate, going from about 17 billion shares to, they bought back over 1 billion shares in the past 2 to 3 years. So that's the sort of stuff that you want to see. So when you actually look at Apple's return, and maybe this is a good opportunity for us to kind of look at it. Let's look at Apple over the past 5 years. And let me see, can I do that? They went from a 57. It won't let me do it. But what we can say, let me share my screen for Apple here, is over the past since 2020, that dip in 2020 when they did their share split recently, they've basically 3x'd. So if we were to go back to here and say, well, has their net income 3x'd over the past, let's just say, a few years? So this is 2020. So about 2020. So they made about 116 billion to now being at about 112 billion. Huh. Okay. Well, that doesn't make sense. Let me just double check that I'm sharing here. I still am. So what has actually happened? Well, in 2020, they were trading at about a 20 times price to earnings. Now they're trading at a 30 times price to earnings. So that would basically increase their share price by about 50% just from that. And then also, they were able to buy back a crap ton of shares. So basically, that's probably where a lot of the money has kind of come from, or the increases have come from since 2020, is you've been able to basically buy back about, I don't know, 10% of the float, maybe a little bit less, and then increase the price to earnings by, say, 50%. I mean, that probably has a good reason as to why the share price has kind of gone up a good bit, not necessarily net income. So that's just another way to kind of think about how sometimes these share prices actually end up moving. Um, so anyway, hopefully that was a little bit helpful. All you have to do is kind of look for shares outstanding. Why would you invest in a covered call ETF rather than doing covered call position you're in? Time. Some people just think that it's easier to invest in a covered call ETF. Um, if you could only pick one stock only, and I couldn't look at it, I'd probably choose the S&P 500. Coming to you live from Houston, land of Vegas. That was like a very early on question. Let me see. Yield max a Ponzi scheme. It could be. So it's a good idea to compare performance of cover call ETFs to underlying stocks. That helps. Thanks for the info. Yeah, it all depends, and it also depends on heavily what positions are they writing, right? Are they writing 1 to 2% out of the money? They're writing 5% out of the money. What stock or what underlying are you using? You know what I mean? So that's all pretty important stuff. What ETF or stock do you, in your opinion, think is the most solid right now? Depends on the eye of the beholder, right? I would say for 90 to 95% of the people that probably are watching this, the S&P 500 is probably the most important stock, and I have over a quarter of my net worth in that, and I'll continue to probably do more and more, specifically on investing in the S&P 500. And reason being is because I generally speaking have a pretty good income, and I've been fortunate and had the foresight to save probably about 30% or more of my income since I started working about 10 years ago. And because of that, to me, having something as simple as the S&P 500 and consistently return like the S&P 500 is probably the easiest way to invest. And I have the opportunity to then focus smaller positions where I can snipe a little bit easier. And that's probably the most prudent thing that I can do. So the hope is to kind of put a lot of that position on autopilot, right? And to me, the easiest thing to do, and I say this all the time, if I were to say spend an hour trading in the stock market, I couldn't guarantee make myself, a couple $100. I couldn't guarantee that. But what I can guarantee is that if I do a side hustle, I have a few side hustles that I do where if I spend an hour or two, I could make $500 or $1,000. So why would I spend an hour of my time trying to day trade where I can't guarantee an outcome, but I spend an hour of my time doing a side hustle where I can guarantee $500 or $1,000, and then I could put that in the S&P 500 and guarantee myself a 6-7% return on that money in the long term. Now that is something that I don't think a lot of people think about, right? So a lot of people are sitting there being like, "Oh, I'd rather just try my luck. Maybe I'll make $1,000 that day." It's like you're more than likely going to lose money, right? And so you're not going to put as much time in there as you want. And I think a lot of times people think like, well, this lost money is tuition to the market, and so I'm going to learn over time. It's like, no, eventually you're probably just going to give up, right? So do you have the right trading rules in place to actually become a very persistent day trader and do things over the time? And do you have as much foresight to recognize when certain things no longer work? So I think it all just depends on where your kind of thoughts are and stuff of the like. So maybe you guys have a gig, or maybe you have a business that generates a couple $100 an hour, and or an $50 an hour or something like that. It's like, it's probably better for you to spend that extra hour in overtime and save it and put in the S&P 500 and guarantee almost that return over, say, 10 years than speculate, right? And a lot of times people invest in really shitty companies. They're like, hey, I've worn Skechers before, let me buy Skechers, right? So there's times where companies are in growth mode, there's times where they become anemic, there's times where they no longer continue to innovate, people's brand tastes change, and it is what it is. It's like the market is the market for a reason, right? If it wasn't the market, people wouldn't be investing. So just a thought process for a lot of people, and hopefully that was helpful. And think that this is something that's pretty good to ask. It goes back to prospectuses and stuff of the like, and just understanding. Sometimes you know something and you think, man, okay, I know this, so it must be true. Not everything's black and white in the real world, and not everything's black and white in the stock market. And hopefully, with that, you can kind of understand this whole hour and a half long conversation at this point. You can kind of understand that. Is SPY better than VOO? And the question is up to the eyes of the beholder. I like to write cover calls on my positions. VOO doesn't have a lot of options liquidity. And so for me, VOO is garbage when it comes to having that extra half percent to 1% a year annualized that I can get from writing covered calls versus a SPY. Yes, you have a 0.07% more of an expense ratio, which I can work off in a week or two. And then the rest of the 40 odd weeks where I have a very positive return on, say, writing cover calls, I'm making extra cash. And so it all just very much depends on really what you're kind of in it for. Now, if you don't write cover calls, nor do you ever plan on it, just put your money on VOO, right? So that's a thought for what your thought process is and how it fits into your portfolio. SPY is great for me because I write cover calls. Maybe you don't like cover calls, so maybe you shouldn't invest in it. So it all just depends on the eye of the beholder, right? What works for me doesn't always work for you. So what side hustles can you make 500 or greater that aren't illegal? This YouTube channel can make some pretty good money in certain respects, right? I have the ability to kind of look and advertise on behalf of smaller companies that want to have CEOs come onto the channel. And so sometimes I have that ability to use that and I get a little bit of exposure for those smaller companies. Now, as always, I would say do your own due diligence. And with that, it's something that some of these companies that come onto the channel could have outsized returns, but a lot of them are also very risky. Some of them might be in the commodity space. Some of them might be in a spot where they're trying to look for oil and gas or looking for silver. And so they're going to the market to raise funds, private placements and stuff of the like. And they're trying their best to see if they can make a mine out of it or what have you. And so they're looking for folks that potentially might invest in the company and be either exit liquidity or invest in the company because it might be something that they can hold long term and potentially make some money. So it all just kind of depends on, once again, your investment strategy. So I think sometimes people think that I have these companies on channel. It's like a lot of times I do it to understand a little bit about the market conditions and say oil and gas or lithium or nickel or the silver mines, and try to get an idea from some of these CEOs, like what's really happening. And so with that, I have the opportunity to bring them on the channel. I'll do kind of like a behind the scenes interview with them, and they'll pay me a little bit of money to post it on the channel. So that's generally what it is. It's no different than what happens on CNBC and stuff of the like. So so you make $100 mowing some lawns. I mean, that's a great opportunity for you to just say, why am I, this is something that you can kind of understand. It's just like, why would I try to cherry pick a stock that may or may not go up when I could go out, spend that hour that I was going to do day trading and, get that $200 extra and put in the S&P 500 and have that grow, that $200 for the rest of your life, and then go do the same thing next weekend, the weekend thereafter that. I recognize that that's much better to do. And a lot of what I was talking about with respect to kind of like some of these things, leveraging your time through paying other people to do things and maximizing efficiency, right? So if you're making, let's just say $500 or $1,000 to do something, you could pay somebody $15-20 to edit it, and you get back, say, a couple hours worth of your time, and you get a finished product and it's about as good, if not slightly better than what you would normally do. Then why not give away a little bit of that money, get some of your time back, right? You could either go and do more side hustles, focus on getting more clients or something like that, the thing that actually makes you money, or something that somebody else can do, which is editing or something you like. And that was one thing that I recognized. Originally, I was doing all the editing and stuff and I do a lot of the editing myself. I mean, I normally just do point and shoot. I don't normally do a lot of editing for a lot of my videos. But for some of these CEO interviews and stuff like that I do, if I'm running like B-roll and stuff, I'll outsource it to somebody, have them do it for say, however much money, and then I'm able to go and go work on other things, so another video or another contract that I can get. And so that's where the real money gets generated, not the editing of the video. So I can focus on the things that I do to bring value and not focusing on something like editing, which I can outsource to somebody else. Now, that I don't say that to talk specifically about my business, my side income, or anything like that. I'm hoping that you can realize what you can do in your own life, right? Say you have the ability to hire somebody to clean your house for, I don't know, $40, and then you can be out in that same time that it would take you to clean your house for 2 to 3 hours, go clear 300, $400 mowing lawns. It's like, well, then it's advantageous for you to hire somebody to clean your house for you, so you can go out and get $200, $300 in income from mowing lawns. So it's the same sort of concept. And I think a lot of people don't recognize that's how money works, right? And so at the end of the day, hopefully that's eye-opening for somebody, and hopefully you can think about how to best utilize your time. And that's probably where I will leave it. Yeah. Oh yeah, you definitely got to do the lawn mowing YouTube channel, but cool. Well, everybody, hopefully that helps you out in any sort of way, shape, or form. We will be back next week, Monday, Tuesday. I'm not 100% sure. I got to talk with Chris. And as always, I will see you guys on the next one. Much appreciated. And